And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Welcome to The Real Investment Show. I'm your host, Lance Roberts, and this is a continuing edition of our interview series. Today, we're very pleased to have a conversation with Joseph Wang, who's the CIO at Monetary Macro, previously a senior trader on the open markets desk. Joseph writes the Fed Guy blog at fedguy.com. He also has a YouTube channel, Joseph Wang on YouTube. I certainly encourage you to watch it because Joseph is the kind of be-all, end-all towards what's going on with the Fed, monetary policy, and of course, this has all been of big concern to the markets this year. Will the Fed cut rates? Will they not cut rates? Every meeting we drift from one meeting to the next. Will they? Won't they? Will they do QE? Won't they? And markets have been responding off of that. So today we're very happy to have Joseph Wang join us and talk about the Fed. And there's a lot of stuff going on. We just had a Fed rate cut here in December. The Fed cut rates by 25 basis points, and notably, I think one of the bigger changes was really kind of 2 points. When they talked about employment, Jerome Powell actually mentioned that, well, the actual employment rate may be a loss of jobs of about 20,000 versus the BLS report showing about 40,000 job increases. And then also noting that they'll be buying about $40 billion worth of treasuries on their balance sheet as they have now ended QT. Let's get a quick recap of your thoughts about the most recent Fed meeting, and then I kind of step back, talk a little bit more macro about Fed policy, how it affects markets, the upcoming change in Fed chairmanship potentially next year. But let's start with the most recent meeting. What were your thoughts on it?
Well, first off, thanks for having me. It's great to be here. So I thought it was a really interesting meeting. It was interesting in a couple ways, but let's level set it a little bit. Now, heading into this meeting, the market wasn't completely sure for the past few weeks whether or not we would get a rate cut. The market was thinking, yeah, we get a rate cut after the September meeting. And then in October, after that meeting, Chair Powell basically tempered everyone's expectations. He was getting a lot of pushback from other Fed presidents, other FOMC members on the board as to whether or not to cut rates. And finally, with a few weeks to spare, you had some more senior people on the Fed basically take their hand and say that we want to cut. And now, looking back, we see that Chair Powell was able to muster enough votes to get a 25 basis point cut. Now, there were 3 dissents. One person wanted to cut by 50, 2 people didn't want to cut at all. And we had some soft defense too, whereas some Fed presidents guided in their dot plot that, we probably shouldn't cut at all. So it was something that Chair Powell was barely able to push over the finish line. But that being said, even though he was just barely able to cut, I thought this was a very surprisingly dovish meeting. And for the reasons that you cite. Now, the Fed is a central bank with 2 mandates, full employment and price stability, and they have to care about both. Now, inflation is above the Fed's target, and we do have the unemployment rate trending higher. So it's in a tough spot. Both its mandates are going the wrong way. But Chair Powell mentioned that according to his read of the data, so, the official data is saying that we're creating on average 40,000 jobs a month. By his estimate, that's oversetting jobs significantly. And over the past few months, we've actually lost on average 20,000 jobs a month. That's negative NFP growth. That's sending a very clear signal that the labor market is not doing well and the unemployment rate is going to trend higher. Now, some of the people on the FOMC are going to say, yeah, the labor market, we're not creating as many jobs because the population is not growing very quickly, right? We have the president enforcing immigration policy. But under any estimate, though, negative 20,000 jobs a month, that's just not good. And the unemployment rate is going higher. So that is, I think, flashing red from the Fed's standpoint. So that's their employment mandate. Now, he was actually surprisingly dovish on the inflation mandate from my read. So we know that inflation has been above the Fed's target for a few years. It's about 3%. But Chair Powell was saying that by his calculations, when you strip out the tariff-related stuff, which is going to be a one-time increase in the price level, right? We're not going to keep increasing tariffs. I don't think anyone expects that. Actually, the president seems to be walking back some of the tariffs heading into the midterms next year. So by his calculation, taking out this tariff shock, inflation is just a little bit above 2%. So you put these two things together, unemployment rate, labor market worsening, inflation basically at target, then you're getting a very, very dovish Fed, because that really greenlights potentially more aggressive rate cuts in the future. Now, how low you can go is going to really depend upon the composition of the Fed next year, because that depends on the debate on what the Fed at the time thinks of as a neutral rate. But I thought it was surprisingly dovish, and I don't think the market is fully awakened to it. I think gold and silver have. We see them surging. We're recording after the FOMC and the day after the FOMC. So I think part of the market gets it, but not everyone else just yet.
Well, I'd like to step back just a couple of things you said, because they are some very interesting points. One is that you're seeing, kind of this weaker employment growth, at least from the Fed's view, which is interesting going into next year, because markets are very, very bullish about economic growth next year. They're expecting another very big surge in earnings for the S&P 500, and particularly even in small caps and mid caps, they're expecting a 59% increase in earnings next year. But that's derived from economic growth, yet the employment data is suggesting that the economy is slowing down. The inflation data also kind of suggests the same thing. And one important point that you bring up, and I just want to make sure that this doesn't get overlooked by our listeners, is that there's been a lot of conversation this year about the tariff. When Trump first announced tariffs, like, oh my gosh, this is going to send inflation to the moon. The Fed's got to start hiking rates. And what we've now find out is that tariffs really haven't been that big of an inflationary impact, because producers are having to absorb a lot of that cost because they can't pass it on to consumers who are showing some signs of weakness. But most importantly, the point you made is that tariffs are a one-time impact. And this is really important for our listeners to understand, is that if I have a product that I sell for $1 and I put a 10-cent tariff on it, so it's now $1.10. Yes, there's an inflationary surge this year on that product. But if the product is still selling next year at $1.10, including the tariff, the inflation rate on that product is 0. So these tariffs are a one-time impact on consumer goods or manufactured goods, whatever they are. But if the price remains the same through next year, there is no inflation from that tariff. As long as we don't keep hiking tariffs every year, that tariff impact goes away.
That's exactly right. That's the standard economist interpretation of tariffs, and that's what the Fed will look at it as well, since they're kind of run by standard PhD economists. So that's the very strong argument why we should kind of look through this. Now, the consumers will give you another story, because they care about the price level, and that's totally legitimate. But the central bank, though, and since they're kind of from market standpoint, how they think is going to be very important, that's how they look at it. You got to look through it. Yep. Now, you raised a very, very important point in that. So we're expecting a lot of good earnings and so forth next year, and yet the labor market it doesn't seem to be doing well. Now, that's another very interesting thing in the Fed's forecast. They actually notably upgraded their GDP forecast next year, even though they left their unemployment rate forecast still relatively elevated. And what that tells me is that they think that we are maybe undergoing a productivity boom, where we can use the same amount of people and produce more goods and services, right? Otherwise, you would expect, in order to get more growth, we'd have to have more people working, right? More labor. You need more labor to produce more goods and services. But from their forecast, though, if they're holding the labor market unchanged and upgrading GDP growth, they're thinking that we might really be in a productivity boom, and that could, be good for growth. It could be good for corporate profits as well. So that's an interesting thing in their perspective that I don't know if it's true or not. I mean, this AI stuff, I use it every day, but I want to be honest, man, I have to check it. And sometimes it makes ridiculous errors. Oh, yeah.
It does. And I do the same thing. I'll use it to write an outline for an article or something. It's like, hey, just, here's my thought about an article, and I'll throw it into ChatGPT and to say, hey, just, kind of flesh out your thoughts on this, do some deep research, pull me some quotes, that type of thing. Certainly makes my, used to back in the day to write an article, I'd have to spend hours literally just trying to go find people's quotes, track down research reports, those type of things. And it does make it a lot easier to do that. But to your point, it makes really wild errors, and you have to really double check your work. If you're using it to work with, it does. Has it saved me time? Absolutely. What used to take me maybe 8 to 10 hours or 12 hours to write an article, maybe I can do it in 4 to 5 now. So it certainly saved me time. It certainly made me more productive. but it hasn't replaced me yet in terms of doing research and work. But I do think this is an interesting point, though. We're seeing a lot right now of, AI spend that's getting, CapEx spending. We're going to build these data centers. When we build a data center, that creates a lot of labor dependency, right? I need electricians, I need carpenters, I need welders, pipe fitters, et cetera. I've got to build roads to the data center. I've got to build electrical grids. So these are all very good things from an economic impact. And I've read some recent reports lately that for every dollar spent on a data center, it has a multiplier of about $3 to $4 in the economy. That makes complete sense. It's good, productive investment. But to your point, yes, this is great. We're going to increase this productivity, but at the same time, we're going to have fewer workers. Or maybe it's the same amount of workers, but they're going to be more productive. But in order to get the economy to grow, we need to be putting people to work for sustainable growth, right? Once the data center is built, it's built, right? So there is a limited lifespan to the economic impact that you get from building a data center. After it's built, it creates revenue, which is fantastic. But those jobs are no longer needed. I no longer need those electricians, those pipe fitters, those welders, those type of things once the data centers are built. So we do need to focus on, kind of creating jobs. Our demographic trends are important for future economic activity. And, that's going to ultimately have to weigh into Fed policy also, is it not?
Well, absolutely, absolutely. And I think they can be AI fact checkers. We need a lot of them.
Yeah.
So I think we're in a really interesting place when it comes to monetary policy because the Fed's mandate is not economic growth. It's the full employment and price stability. And if we have all this stuff that's actually pushing the unemployment rate higher, even though GDP growth is strong, the Fed is bound by that unemployment mandate to actually continue to lower rates, to try to do what they can to stimulate job growth and employment. So, that sounds like it's something that could be very positive for financial markets because on the one hand, you continue to have this GDP growth that's good because of, let's say, technological advancements. And a little bit speculative on that, but that seems to be what people are saying.
Right.
And also lower interest rates. So I think that's something that is a potential scenario for next year. Whereas even though markets go higher and people are like, why are you cutting rates? GDP is so high. It's because of labor mandate. And like you mentioned, we have these big societal changes where, maybe it's more difficult for some people to find jobs.
Well, it's interesting. I've talked about this on my show from time to time is that, there has been a shift in kind of Fed policy, let's call it pre-2008. The Fed really was just focused on kind of two mandates, unemployment and price stability, which was fine. And then, of course, after the financial crisis, we started doing quantitative easing. We had the first quantitative easing coming out of the financial crisis. That ended in June of 2010. And then in September of 2010, we launched the second round of QE. The reason I bring that specific one up is that Ben Bernanke made a statement that really appeared to change the role of the Fed mandate because he says, while price stability and full employment is our job, that's our mandates, we're also focused on the reason we're doing QE is to lift asset prices to boost consumer confidence because that contributes to economic growth. And then, of course, since then, we've done every time there's a downturn in the markets or a downturn in the economy, we have QE, we have bailouts, whatever it is. Has that unwritten third mandate, is that still in the Fed policy's playbook or are they trying to revert back to strictly just their two mandates?
So that speech by Ben Bernanke is very memorable. He talks about the wealth effect, portfolio rebalancing channel, so forth. And the context, though, is really important. Now, after the great financial crisis, as we all know, we had the Great Recession. And so we were at a really weird place in monetary policy where interest rates were at zero, and yet the economy was still very sluggish. And so the Fed was at a loss of what to do. We've already cut to zero. So it came up with an idea, hey, maybe if I try to lower long-term interest rates through QE, then I could get asset prices up. So, help housing market recover. The housing market was not doing very well back then. Maybe send equity markets higher. And in that sense, if people were to feel wealthier, maybe that would mean that they would spend more and that would speed on the recovery. Now, that didn't actually work super well because we did have a slow recovery for the many years. But fast forward to today, that's kind of like how the economy works, right? So we have a lot of people talking about, say, they call it the K-shaped recovery, where uh, a lot of the spending in the economy is driven by this upper end that holds assets, that is feeling very well because the equity market is so high, and they just continue to spend, and that's boosting the economy. So I guess Bernanke's vision of the world did eventually work. He just needed to get asset prices a lot higher.
Well, it only took an additional $5 trillion in spending after the COVID pandemic to do that. But yeah, it worked great.
Yeah. So I'll say this about the Fed. So we're at major crossroads in how this is going to operate, and two things are so the Trump appointees, they have a very big different vision of the Fed's balance sheet, and I think that might kind of link to how we think about this wealth effect thing. So what the Trump appointees are saying, and it's very consistent, including Secretary Bassett is also saying this, is that they would like the Fed to have a smaller balance sheet. And what that means, of course, is just unwinding this QE that we've had over the past, post-Great Finance, past decade or so. They want lower rates, of course, on the front end, but they also want a smaller Fed balance sheet. So how this is going to work out, I'm not too sure. I suspect that if you were to meaningfully shrink the Fed's balance sheet, you'd probably unwind some of this wealth effect that the Fed has been kind of doing the past decade, and that might be politically unpopular.
Well, that was my point, though, is that every time we've had a downturn in the markets, or just or even the hint of a recession, right? We've seen the Fed come in. Silicon Valley Bank crisis immediately came in. Provided a bailout for the banks, and that's okay, right? We don't want to have financial stress in the system. I get it. We had the downturn because of the pandemic, massive amounts of QE, buying, junk bond ETFs, whatever it was, to kind of keep the system going. But it doesn't seem like the Fed, and maybe this is the political bias to your point, right? They get pressure from the government, then the Fed reacts in kind, is that every downturn needs to be stopped because you don't get reelected for office if you go up for election in a recession or a big bear market, right? So it seems to be they're stuck between kind of a rock and a hard place. In order to get the balance sheet down, you need to have a decent correction in the markets. And that's going to be 30, 40% at least, right? And maybe we're talking about a 50% correction in the markets to really meaningfully unwind that wealth effect to allow the balance sheet to get down. But there doesn't seem to really be a tolerance for that to occur. So I think I'm kind of in your camp, which is I don't know how you get to shrinking your balance sheet without having a severe economic downturn, because you're going to, by reducing the balance sheet, you're going to extract liquidity from the markets and the economy.
So I think reading between the lines, I think their plan, and again, it's hard to execute this plan, but their plan is to heavily deregulate the commercial banks and have them take over the Fed. So one of the things that the regulators have done this year is basically to adjust something called the supplementary leverage ratio, which is something that made it expensive for banks to buy low-risk assets like U.S. Treasuries. Now, the regulators, when they released that proposed rule, they also included economic studies on what they think the impact could be. And that study is a hypothetical, and that if you had this rule, hypothetically, you could have the banks buy, over, I think, $1.1 trillion in treasuries more because of the deregulation. Doesn't mean they will, but it does mean that it'd be cheaper for them to just hold more treasuries. They could do that much. Probably won't, unless maybe the government offers some persuasion to that end. So I think their goal is to just shrink the Fed and then grow the banking sector a little bit about like how the economy worked before the great financial crises, basically reprivatizing the financial system, as I think they would call it.
Okay,
I don't know if it'll work, but it'd be hard.
Well, I think that's a great point, and I think that's a very interesting point, that we're talking about having the banking cartel take over the Fed. But pre-2008, I think this is a really critical point. Pre-2008, the top 5 banks made up maybe 20% of the banking sector. After the financial crisis, they're 40%. Now they're closer to 50% of the entire financial system. So, but we fostered that, right? When we were going through the financial crisis, we bailed out Goldman Sachs and JP Morgan and Bank of America and all these other people because we didn't want to have that banking crisis post-Lehman. And so we bailed out all these banks and consolidated the bank sector into a very small, powerful group of banks that are all part of the Federal Reserve Board as well, right? I mean, because they're member banks of the Fed. So, pushing that responsibility onto the actual major banks to effectively, quote unquote, take over the Fed, isn't that kind of putting the fox in the henhouse, so to speak?
I think control of the Fed. I think what I observe is that it's not so much the private banking sector that has growing influence over the Fed. It's more of the executive, the elected government. So before the great financial crisis, the banking sector was super powerful. They were making tons of money. They were like the big tech sector today, and they had a lot of lobbyists and so forth, and they were writing rules that helped themselves. But after the great financial crisis, they had a lot of egg on their face, became very politically unpopular, and the regulations since then really kind of shrank their influence and shrank their profitability significantly. So if you have deregulation, there is the potential that they could become more profitable and more powerful. But you also, of course, level the playing field a little bit, because all these regulations are actually very onerous for small banks. They don't have these huge compliance budgets. They don't have this huge technology. And so in a sense, it makes the playing field a little bit leveler for the smaller banks. So
okay.
It's interesting to see how
right.
these two potential scenarios that this could develop.
Yeah, no, and that's a great answer. I mean, I don't know how this is going to play out either. It just seems, as my son would say, it seems very sus. But it is an interesting situation. Because the other problem that potentially provides a financial headwind is if you're trying to unwind the balance sheet, right? You remove the buyer from the market, interest rates potentially go higher. Interest rates, obviously, that's going to impact borrowing costs, discounted analysis values for stocks, et cetera. So higher interest rates are going to affect the housing market. It'll affect the multifamily markets. Kind of all the things that are tied ultimately to interest rates. How would the Fed approach unwinding their balance sheet? And again, maybe it is in conjunction with working with the major dealers like J.P. Morgan, et cetera. How would they potentially orchestrate that unwinding of the balance sheet without causing interest rates to rise fairly sharply?
That's really tough. A few years ago when Bernanke tried to do that, he had the very infamous taper tantrum where he mentioned that, maybe we might, stop QE, and then, the market just kind of went crazy because they weren't expecting that. Right. So it's not just that the Fed has a huge amount of treasuries, but the stock of treasuries continues to grow because we have a $2 trillion deficit. So I personally am very skeptical as to how we could easily unwind the Fed's balance sheet. If they do this, I think it will be disruptive, and maybe they'll change their mind. We do see that after we saw it in Liberation Day, right? Big tariffs. That's maybe not a good idea. Let's have smaller tariffs instead. So maybe they'll do something like that, or they could, of course, just do this over a long period of time. So long that it doesn't matter. Right. So that's another possibility.
But let's talk about let's talk about something that the Fed did do kind of in this regard at the most recent Fed meeting here in December, is that they did announce that they're going to buy $40 billion worth of bonds on their portfolio. They ended QT as of the end of November, which means, and again, it's very important. I saw a lot of articles running around. It's like the Fed's still buying bonds, even though they're saying they're shrinking their balance sheet. They're still buying bonds. Here's the latest numbers. But it was because of the differential between what was rolling off and what was maturing. And so they were buying the differential between, I had $50 billion worth of bonds mature this month, but I only wanted to roll off $20 billion, so I buy 30, right? So everybody was like, oh, that's still QE because they're buying bonds. No, they were just trying to manage that runoff in their bond portfolio. But they ended that QT altogether, which means that does provide more for the potential of the Fed to buy bonds now, because now every month when mortgage-backed securities mature or treasuries mature, they're going to have to buy those bonds just to maintain the balance sheet value, right? One thing my partner brought up this morning, and I thought it was interesting, is so they're going to buy short-term bills, but that doesn't mean that in the future, when those short-term bills mature in 3 months or 6 months or a year, that they couldn't then turn around and buy 10-year treasuries if they needed to put them on their balance sheet and to somewhat provide yield curve control. Is that a fair thesis?
So I think it's important to think about this from the Fed's perspective. So from the Fed's perspective, when they go and they print money and they buy stuff, they categorize it as QE when they're buying like duration, like you mentioned, 10-year securities. Because when they do that, they're taking duration out of the marketplace, putting downward pressure on long-dated interest rates. From their perspective, that's QE. Now, if they go and they buy Treasury bills, they don't think of that as taking duration out. They think of it as just adding cash into the financial system to make sure it works better, and they call that a reserve management purchase.
Right.
Now, at the moment,
but just real quick, and that's exactly what they announced at this last meeting. So go ahead.
Exactly. That's right. Now, in the future, they could definitely change their mind, and if they want to buy duration, roll out QE, they can definitely do that. That's going to be a decision that is going to be made by the Fed. By a future Fed. This one is not going to do that. The way that the Fed traditionally operates, and I say traditionally because maybe in the future they will operate differently, is that the way that they operate is that they would cut interest rates as their primary policy tool, and only when the interest rates are at zero, then they start doing QE by buying duration. So but according to how they operate today, they would have to go to, first they would try to cut rates. If that doesn't work, then they'll start buying duration.
So that's an interesting statement because Jerome Powell said, I think that this was maybe a couple of years ago after the kind of the pandemic meltdown, et cetera, he said, we're never going back to zero interest rates. So if you're never going back, and again, just because he says it doesn't mean they won't do it, but if you're not going to go back to zero interest rates, let's just for you and I, just for thematic purposes, we say the floor is now 2%. We're not going to cut rates anymore below 2%. Okay, fine. At what point then do you start doing QE if the long end of the curve is going up and starting to impact economic growth? Again, part of their control structure is going to want to control that longer end of the curve to make sure it doesn't impair employment, inflation, and economic activity. Right?
So I think before they do that, they have another policy tool, not them, but the Treasury. And this is what we've seen being deployed actually in Japan right now. So a few months ago, we were talking about how the Japanese long end is kind of blowing out, going up every day. And what they did was that they began to just issue fewer JGBs in long end and borrow more from the front end, from the belly. And so by simply reducing the supply of long-dated JGBs, they put downward pressure on the yield. And so in the future, before we get into the Fed having to do anything, what the U.S. Treasury could do, and they've been doing this for the past couple of years, is to just issue more in the front end, issue more bills, issue more in the medium term, so let's say up to 5, 7s and so forth, and issue relatively less 20s and 30s. And that's also helped the bond market digest the issuance that they have. So that's something that the Treasury could continue to do. So at the moment, about 22% of all treasuries are bills, and bills are front end, and they could easily increase that to, let's say, 30%. That would actually still be historically within norms. Over the past 50 years, the average share of bills is 22%, right where we are.
Right.
In the past, when interest rates have been high, saying let's say 70s and 80s, that bill share has been significantly higher than 22%. And I suspect that if we do have problems with the long end, that's what Treasury will do before they go in and try to make the Fed do anything.
Well, and again, that's not surprising. And one of the concerns that is kind of starting to run around a bit is that next year there's a very big set of maturities coming due for government bonds. They're going to have to be rolled over. And again, kind of the panic in the market is like, oh my gosh, we're going to default on our debt because we got to roll over this all this debt at one time. Is that really a concern that we should be focusing on, or is this something that the government government, i.e. government, Treasury, Fed, the entire cabal, can they manage that rollover of the maturities?
I'm not worried about that. So the way that the Treasury operates is that we have a perpetual deficit, right? So we're always rolling over debt, right? So how do we repay maturing debt? Well, we just borrow again, right? So that's how it operates. It's actually a really predictable schedule. So a lot of the people who lend to the Treasury, when they get their money back, they just roll it into the new issue. So it's something that's totally normal way of operating. I don't worry about it. And of course, if there was some kind of accident, we would actually expect the Fed to come in, not the Treasury, because when it comes to financial stability, the Fed thinks it has a financial stability mandate. The Treasury market is viewed as essential. And so they would just come in and, at least temporarily, try to paper it over. We saw the same thing happen in the Bank of England. A couple years ago, we had that moment in the gilt market where after Liz Truss announced her new budget, there seems to be an accident in the gilt market. Yields blew up higher. Bank of England came in, bought a whole bunch of gilts. And when the panic was over, they actually sold it back to the market. So you could see the Fed do something similar. At the end of the day, this is a fiat system. Everything is just a number in a database, right? So you don't ever want to expect some kind of unsolvable accident here. The only thing that you really can't protect against is your currency. That's much more difficult to protect against. And so I think in the future, if we do have this kind of a big bear market or a financial accident, what we want to be concerned of is mass capital flight out of the United States, because they're, worried about policy, worried about politics or something like that. That's something that's not easy to fix, because that's people, foreigners trying to get out of your fiat system and go to another fiat system. Unless you have capital controls, which I don't think we will have, it's really difficult to fix. But rates, things like that, these are things that can be fixed by the current tools that we have. So
just to sum that up, for all the YouTube channel, headlines that we're going to see over the next 3 months heading into next year, debt default coming, the world's about to end, the governments can't afford to finance their debt. Those are not concerns that we should be worried about.
Those get a lot of YouTube views, but no, I don't think that's something I would worry about.
Well, let's shift gears here. I'd like to touch on the administration change that's coming out. Two things of this recent meeting that I thought that really jumped out. One is right after the meeting, President Trump came out and said the Fed didn't cut enough. They should have cut at least 50 basis points. But that kind of leads into kind of what you were talking about earlier with the most recent dot plot, who was voting on the dot plot. I think Steve Moran was the one guy out there voting for a 50 basis point cut, if I'm not mistaken. But Kevin Hassett appears to be kind of the clear front runner to replace Jerome Powell as the Fed. I kind of like to get your thoughts on just kind of both those items and kind of what you think.
I think the market is severely underestimating the potential for there to be a Trump-controlled Fed next year. So just taking a step back and looking what has happened over the past few months, you have a Supreme Court case where the president is trying to fire a sitting Fed governor. You have the Secretary Besson, floating ideas on how he could maybe change the composition of Fed presidents, some of which are very hawkish and voting next year. And of course, you have the front runner for Fed Chair Kevin Hassett to basically be the president's longtime economic advisor. He's been with the president for over a decade, and I think we can be pretty confident that he's going to try to carry out the president's wishes. So what I observe is an administration that is very determined and very resourceful in trying to have more control over the Fed. Now, what do they want? Lower rates. How low? Well, I think we could actually look to Governor Myron's speeches to have an idea. Governor Myron thinks that maybe we should be around 2.5%. And so the market right now is pricing in the bottom of the Fed cutting cycle to be about 3%, which in the Powell Fed is what the medium voter on the Powell Fed thinks of as neutral. Now, the Trump Fed looks like it's going to be 50 basis points lower at least. So it seems like they have enough political resourcefulness to be able to carry that out. Kevin Hassett as Fed chair, maybe do some other things. Don't know how successful they will be, but I think they'll have some success. Now, one thing I'll note is that when it comes to the federal government, the law and all that stuff, it's not super binding, right? I mean, if you look at history, the government does all sorts of things that are somewhat gray and probably illegal. What really constrains the federal government is politics. And what I find super interesting today is that even as the Trump administration is pushing for lower rates, you don't really hear a lot of opposing political voices saying that, we got to protect the Fed independence. No, we don't want these rate cuts and so forth, because I think the public, rightly or wrongly, perceives that low rates is going to help with their affordability problem. And affordability, especially when it comes to housing, is one of the number one issues in the public. And I think the public broadly perceives, rightly or wrongly, that if we get more rate cuts, mortgage rates will come down, housing will be more affordable, car loans will be more affordable, and both political parties kind of are okay with this. And so because I don't see that political resistance from the opposing political party, I get the sense that, we could have a good chance we could actually have this Trump-dominated Fed and get more rate cuts than the market currently is pricing in.
Yeah, let me just say something real quick too, because I think there's a distinction that we need to make here, which is the fact that the kind of the 3% target, the 2.5-3% target rate for the Fed right now, that's premised on the idea there's no recession, that we're gonna have a soft landing, everything's gonna be fine. We have to cut rates just to kind of stabilize inflation, stabilize employment. A recession would potentially throw that out the window, right? That would
absolutely.
Yeah.
We would have aggressive cuts. We have non-farm payrolls next week. Who knows if we get a negative print, that could really freak the market out, and they could be pricing in a lot more cuts than up to 3%. So you're absolutely right. The economic outlook could also be something that forces the market to price in a lot more cuts.
So we say that Trump has the ability to potentially have more control over the Fed, but the Fed's been pretty acquiescent to past administrations. I mean, they've always kind of worked with the administration to achieve better outcomes. So is it really that big of a change just because Kevin Hassett may be, kind of have a more of a bias towards going along with what the president wants? But at the end of the day, I mean, you've still got to get the votes from all the voting members of the Fed, right?
So I think it is different this time. I mean, so when have you ever seen a president fire a Fed governor on Twitter and then have the case go before the Supreme Court, right?
It's always entertaining.
Very, very interesting. So Governor Moran, he's a very sharp economist. He is actually still keeping his position in the White House. So he's kind of doing this on a temporary basis. And of course, he's advocating for 50 basis point cuts this time, and the last meeting, and the meeting before that as well, kind of what President Trump would like, right? So I think this is a big departure in how things used to work. Now, how they get to have more influence, you're right, the Fed chair has one vote. It's the governor's vote and the Fed president's vote on a rotating basis. And so that's why we hear plans like from Secretary Bessent, just kind of mentioning maybe we could have some new rules such that when the Fed presidents are up for reappointment next year, that would coincidentally kind of disqualify the most hawkish Fed presidents. I'm sure that wasn't intended, right? So they're just thinking about ways to do this. I don't know what other ways they have.
Yeah.
This I think a couple of days ago, the president was at a rally and he's like, some of these Fed governors, their appointments were signed by the auto pen. And we know the auto pen is not legitimate, right? So are these Fed governors, is that legitimate? So again, this is probably not a high probability thing, but they're finding ways. And I suspect that they will eventually find something that works.
Let's just run this thesis real quick and just say, okay, let's just assume that the government gets their wish. We get Kevin Hassett on board. We get all dovish governors, and we start more aggressive rate cuts. What's the negative outcome of that? Where does that go wrong? Is I guess the question.
Yeah, well, I mean, I think the risk is that it just blows a tremendous bubble in financial assets, and ultimately that comes crashing down. And when that happens, it's deep recession, and at this point, probably deep social and political unrest. I think we're at a moment where there's tremendous inequality in the economy, and a lot of people feel left out and very unhappy. And I think that that will be magnified several-fold if we initially have this huge asset boom and subsequent bust. Right. It is also possible that if you keep rates very low, you have higher inflation, and that is also very socially destabilizing as well. I want to be cautious about that, though. So one of the observations that I've made over the past couple of decades is that we think that there's a strong relationship between interest rates and inflation, but I just don't really see that because, let's say, after the great financial crisis, interest rates were at zero, didn't really see inflation that much. We hiked rates to over 5%, and inflation is still, above target. So there's a lot of things that impact inflation. Government spending, for example, your trade policy, right? If you're importing a lot of goods with tariffs, that's going to impact inflation as well. And what if you have technological advancements that make everything cheaper to produce? So inflation is a really complicated thing, and I think it's too simplistic to view that through the lens of interest rates. But interest rates definitely huge impact on financial assets, and so I see gold and silver react strongly. I think there's the potential that we just have this big boom and bust, which ultimately will be very bad for the economy and for American society.
But as long as it's not on my watch in terms of an elected official, right? I can have the boom during my period, but as long as I'm out of office before the crash, it's all okay, right? Let the next guy deal with it. But
that's unfortunate.
Yeah, but that's the way it kind of works out. All right, Joseph, a great conversation today. Is there anything that we haven't talked about today that you think is important?
No, I think we talked about a lot of wide-ranging topics. One thing that I'll note is that, one of the things that I observe is that we just have these huge changes in the world, just how we operate, the very basic rules that we are used to operating under, right? Like a politically independent Fed. And so we want to be cautious when thinking about the future because it looks like the future will not look like the past. So I think it requires a more humility and a lot more context and judgment going forward.
Joseph Wang, he is the Fed guy. He writes for the fedguy.com blog. I encourage you to go by his website, get his latest work. Joseph, what are you working on right now? What's your next piece
also,
coming up?
I would also just going to plug my book, Central Banking 101. It's available on Amazon. It's the bestseller in its category. If you guys are interested in understanding financial system, definitely go and check it out. Yeah,
and the great thing about that category, I think there's like 2 books in the...
Well, mine is number 1.
I'm teasing. Congratulations on that, Joseph. That's awesome. But yeah, go by Amazon.com, get his book, Central Banking 101. Also, follow him on YouTube at Joseph Wang on YouTube. So again, please follow him. We've had his email address up today. If you've got questions, reach out to him. Joseph, we really appreciate your time today, and would love to have you back, particularly next year once we kind of get through kind of the beginning of the year, start looking at what the Fed's going to do next year. I'd love to have you back just to discuss kind of what to expect next.
Great. Look forward to chatting next time.
All right. Thanks, Joseph. That is the Real Investment Show for today with Joseph Wang. Be sure and like and subscribe to this YouTube channel. It helps us get great guests like Joseph Wang here on the show. So your likes, your subscriptions here certainly helps us out. So like and subscribe to the channel today. Also get by the website, realinvestmentadvice.com. We post all of our articles and research there every day at the website, realinvestmentadvice.com. Have a great day. We'll see you back here for the next edition of the Real Investment Show.